This is the 8 steps in accounting cycle. We start with original transactions, and then we have to end up with some output, which are financial statements. So at the end of the day, what we really want to achieve at the end of the accounting cycle, and end of accounting cycle is a financial statement. The reason why we want to produce a financial statement, just quickly record what we did last week. We want to provide users with useful information, and these users could be investors, could be lenders. So the users, such as investors and lenders, they will need to rely on financial information from financial statement to make financial decisions or to make any economic decisions. As we also have discussed very briefly last week, there are 4 financial statements. We have a balance sheet, income statement, changes in equity, and also statement of cash flow. At the end of week 5, we want to be able to prepare at least 3 financial statements: income statement, balance sheet, and statement of changes in equity. Then in week 11, we will need to know how to prepare statement of cash flows. Okay, so we are going to learn about these steps this week through to week 5. Now the focus today is the first 3 steps. So I will repeat again, and I will want to emphasize this point once again, that all these topics in accounting circle are related to each other. So make sure that you understand every single topic, especially the one we have today through to week 5. You make sure that you understand these topics well before we move on to more complicated topics. Okay, so let's talk about the first 3 steps. The first one is the source documents, which is the evidence that transaction has occurred. So this is our starting point for recording transactions. The source documents can come in form of invoices, invoice checks, bank statement, receipts, and things like that. So that is our source document, which is a starting point of recording transactions, because these are the evidence that transactions have occurred. Now in this unit, the questions itself, the question per se, are the source document. So in this unit, you need to analyze the source documents, but then you do not need to check if the source document is true or if a source document is a real source document. So the questions we provided to you in the tutorial, they are the source document. Right. The next step is to analyze transactions or to recollect transactions in journal entries. Now, for those of you who have done accounting before, it is quite easy to understand how to put transactions in your journal entries. For those of you who are doing accounting for the first year, you may get confused. What do we mean by journal entry and what do we mean by journalized transactions? So before we talk about journal entries, I'm going to show you how to analyze a transaction, and then that will help us to prepare journal entries. Okay, so let's take a step back and try to analyze the transactions in order to help you understand the transaction, and then help us to prepare a journal entry. Firstly, what do we mean by transactions? Transactions are exchanges between 2 or more parties. This may affect business along various stakeholders, for example, customers, suppliers, banks, and employees. A business transaction may involve the owner, but if a transaction only affects the owner, not the business, then it is not a business transaction. For example, as the owner of a restaurant, I use my own money to purchase flowers for my personal use. This transaction is not a business transaction, as the business, the restaurant, is not affected. This is an example of a personal transaction. It has nothing to do with a business. Therefore, we do not record this transaction. But if a transaction is related to a business in any way, we will have to recognize the transactions in the journal entry or in the accounting system of the business. Again, we only focus on business transactions because a business is a different entity or a separate party from the owner. We do not record personal transactions. Now, in order to record transactions into our accounting book and prepare journal entries, we need to know how accounting equation works. This is an equation, or this is something that I have briefly touched on last week. And this is the concept you need to understand and also be able to use for the rest of the semester. The accounting equation is simply assets that equals to liability plus owner's equity, or what we used more often last week was owner's equity is a residual of assets minus liability, which is owner's equity equals to assets minus liability. Okay, what does this equation tells us? This equation shows us a relationship between assets, liability, and owner's equity, such as how much of asset is financed through liability and how much of the asset is contributed by owners. A very important point here is that this equation must always stay balanced. So what you have on the left-hand side, which in this case is just asset, must always equal to what you have on the right-hand side, which in this case is a total of liabilities plus owner's equity. And in order for this equation to be balanced at all time, in every single transaction, there has to be at least 2 accounts affected. There has to be a minimum of 2 effects in order for this equation to be balanced at all time. It may not make sense to you at this stage, but I'm going to show you how this all works very slowly in the next few slides. So back to transaction analysis. In any transaction, whenever we throw you with a transaction, you will have to ask yourself the following 3 questions. The first question is which accounts are affected in this transaction. And whenever we talk about accounts, you may notice that here we talk about plural. It means that it has to be at least 2 accounts, 2 effects. It has to be at least 2 accounts affected. It cannot be just 1 account. It cannot just be 1 effect. It has to be 2. It can also be 3. It can also be 4. It can also be 6. But it has to be at least 2 accounts affected. Then the next question that you need to ask yourself is what happened to these accounts, whether one account increases or they decrease, whether the second account increases or decreases. The last question you need to ask yourself is, after you have answering the first 2 questions, does your accounting equation remain balanced or not? If not, then there must be something wrong. So the easiest way to illustrate these 3 questions is to do a few examples. The first example here is we have an owner provides 50,000 cash funds into a business to start a business. So you ask yourself these 3 questions. Okay, so I'm going to apply them into the scenarios or into the examples we have in the lecture. Now, the first question here is which accounts are affected. In this case, we definitely have cash because you can say cash here. Okay, so we definitely have a cash as a question tell us so. The business has received 50,000 cash from the owner. So the first element, one of the elements or one of the accounts you have here is a cash. Now, as we have discussed earlier, we have to have another element or the second account or the second element. The second one is likely to be capital or owner's equity because the cash is coming from the owner. Now, please note this is not a personal transaction because it's a transaction does not just involve owner, the business is also affected. So this transaction affects both of the owner and the business. Okay, this is a business transaction. This is not personal transaction. The business is affected because the business had received 50,000. Now, so far, we have identified two accounts here, cash and capital. The next question is what happened to these accounts, i.e. increase or decrease. So what happened to cash from the business? Well, we have to look at this from the business perspective. Okay, so we look at the transaction from the business perspective, not from the owner's perspective. In this case, cash increased by 50 because the business received 50,000 cash. At the same time, the owner's equity in the business also goes up by the same amount. Now we have identified the two accounts. The next question is we have identified the two accounts, and we also talk about whether each account increases or decreases. Then the next question, which is also the third question, does your accounting equation remain balanced? Does your accounting equation remain balanced? Let's have a look. So what we have here is on the left-hand side of accounting equation, it increased by 50,000. And then when you check the right-hand side, it also increases by 50,000 by the same amount. So overall, the accounting equation remain balanced. All right, so that is how do we do transaction analysis. I want to bring to your attention that at this point, what we are doing here, it is not a journal entry. It is not a journal entry. This is just a business analysis. But you need to understand this concept. You need to understand how to do a business analysis before we can do a journal entry. So hopefully this business analysis makes sense to you. We identify at least two accounts. Then you want to identify whether each account increases or decreases. At the end, please make sure that accounting equation always remain balanced. Now, let's do another example. So we have a business purchased a 90,000 motor vehicle and finds it by borrowing. First of all, we have to identify accounts that are affected. You can say a bank loan here, which is a liability. So one element is a bank loan liability account. And according to the description of a case, the second account affected is a motor vehicle, which is a asset account. So the two accounts we identified are bank loan and motor vehicle. So our first question, which are two accounts affected, is already done. Then the next question is what happened to these accounts, increase or decrease? So what happened to motor vehicle? Well, from the business perspective, there is an increase in motor vehicle because they have a purchase of motor vehicle. So they have one more motor vehicle within the business. The motor vehicle increases by 90. At the same time, their liability also goes up by 90. Okay, so essentially the bank loan goes up by 90 because they have borrow money to purchase the motor vehicle. So in this case, there was an increase in both asset, which is a more physical type of asset, motor vehicle, and an increase in liability, which is a bank loan. The third question is, does our accounting equation remain in balance? So let's check both sides. The left-hand side increased by 90. The right-hand side, which is a liability, increases by 90. Overall, our conclusion is that our accounting equation remains balanced. So as a quick summary, whenever you come across with a transaction analysis or any transactions, the questions that you need to ask yourselves are following three. Which accounts are affected? What happened to these accounts? After answering the first two questions, then please check if the accounting equation remain balanced or not. So that is what you do in every single scenario. Let's do another example. In this case, we make a repayment of 35,000 of a loan, and then we made the payment by cash. So which two accounts are affected? Well, definitely we have cash here. And another one is a bank loan. Again, it is a liability account. What happened to these accounts? Well, we made a payment to the bank. So as far as our business is concerned, cash decreases. And then when you pay to the bank, what happened to your bank loan liability? It has to decrease. Okay, it does not make sense that you make a repayment and your liability goes up. So when you make a repayment to a bank loan, the liability has to decrease. So the liability decreases by the same amount of the cash you paid to the bank. As you can see, both assets and liability decreased. Left-hand side decreased, the right-hand side also decreased by the same amount. Then the conclusion is that accounting equation again remains in balance. Let's do another example at so as you can see that we have done several examples. The reason why we provide you with a number of examples here is for you to master this topic, to master transaction analysis. The only way that you can master this is to do as many examples as possible. Okay, so let's come back to this example. Now in this example, we use a cash purchase a computer. Which two accounts are affected? Well, the accounts affected are cash and computer. Both are asset accounts. The next question is what happened to these accounts? We pay cash, so we pay cash. So our cash definitely decreases. We pay cash to purchase a computer, which we get a new computer. So we have one more computer in our accounting system. And the computer as another asset account also increases. Okay, so if you look at this accounting equation, as you can see on the screen, these changes, both changes, increasing computer and a decreasing cash, both changes happen on the same side, which is left-hand side. One account increases, another account decreases. So the net effect here is our accounting equation remain balanced. There is no change in our liability. There is no change in owner's equity. In this case, both changes happen on the same side, which is fine. Okay, so happen in the same category of financial elements. Both are asset accounts. Now, increasing asset accounts cancel the decreasing asset account. So you have asset coming in at the same time, you have the same amount of asset going out. So the asset cancel out the asset itself. Overall, the accounting equation is still in balance. Now, so far, we have talked about 3 out of 5 accounting elements. We talk about asset, liability, and owner's equity on the accounting equation. If you remember, we actually have 5 accounting elements. We also, in addition to asset, liability, owner's equity, we also have income and expense. So how do we fit income and expenses into accounting equation? We have to come back to the definition of income and expense. So recall the definition of income we did last week according to conceptual framework. Income is an increase in owner's equity. So in this case, we will put income as addition to owner's equity. The income is showing on the right-hand side of accounting equation, which is a positive number on the right-hand side of accounting equation. Income increases owner's equity, then the income should stay on the same side of owner's equity. Now, what happened to expenses? According to a definition of expense as per conceptual framework, expense is a decrease in economic benefits, or it has to be ultimately decreasing owner's equity. So when we fit expenses into accounting equation, it has to be a reduction. It has to be negative, minus, subtracted from owner's equity on the right-hand side. And what you can see on the screen there, this is the complete version of accounting equation. Now, of course, if you want to rearrange this equation to make all elements have a positive sign, you will get another version of accounting equation, which is assets plus expenses on the left-hand side. So on the left-hand side of accounting equation, you have assets plus expense. Then on the right-hand side of accounting equation, you will have a liability, owner's equity, and the income. Now you will see the second version of accounting equation in more often from next week onwards. Okay, so we will use asset plus expense that equals to liability plus owner's equity and the income more often in this unit. Either way, they are the same. Okay, so they are the same. They just arranged differently. All right, so let's apply this full version, complete version of accounting equation into some examples. The first example we have here is we make a $200 cash sales, which accounts are affected. It will be cash and sales. So sales is an income account. You can also create a sales revenue. So you can create a sales or sales revenue. Sales and a sales revenue, the revenue account is an income account. What has happened to these accounts, whether it's an increase or decrease? In this case, cash increases because we receive a 220 from a customer, from a third party. In addition to that, our income, which is a sales, also increases by 220. So both sides, both left-hand side and right-hand side increases by 220. Overall, our conclusion here is accounting equation remain in balance. The next example we have is we have a staff work for an entity for wages of 990, which has not been paid. Okay, so I want you to bring to attention that this wage has not been paid. That means the cash is not yet involved. So there's no cash. We have not got cash. So which two accounts are affected? Well, the first one is wages expense. The wage owing to employee or to staff is an expense account, not asset account. Okay, so we have a wages expense, not wages asset account. The reason for that is because the economic benefits from the employee, had already been consumed. Okay, so the employee had to work for us, then we pay employee for the work they have already done. That means if you check the definition of asset for a transaction, for an item to be recognized as asset, it has to produce a future unconsumed economic benefits. If the economic benefits has been consumed, like in this case, employee had to work for us, but we have not paid them, then that becomes an expense instead of an asset. Okay, so since the economic benefits from the employee had already been consumed, in this case, we have a wages expense instead of an asset account. So the first account affected is a wages expense. What is the second account affected? In this case, we have not yet paid the staff or we have not yet paid employees. That means we will have a present obligation to pay employees or to pay staff 990 in the near future. So when we talk about present obligation, immediately that will click into your mind. It is a definition of a liability. So the second account we want you to recognize is a wages payable, which is a liability account. Overall, two accounts affected are wages expense and wages payable. Wages payable is a liability account. Now, in this case, we have an increase in wages expense by 990, and the wages payable also increases by 990. Now, if you look at the first version of a complete accounting equation, since expense is a negative on the right-hand side, an increase of 990 in expense means a minus 990, which cancels a positive 990 from liability. Of course, you can rearrange the equation. You can get another version of a complete accounting equation, which we moved expenses from the right-hand side to the left-hand side, and the expenses become positive on the left-hand side. Then in this case, you will still have an increase in wages expense, but it sits on the left-hand side. And you still have a positive increase in the right-hand side, which is a liability. So the positive increases on both left-hand side and the right-hand side cancel out each other. Or the conclusion here is that accounting equation remain in balance. Okay, as a summary for questions like what we just discussed, that is to analyze a transaction, to do a transaction analysis, there are 3 questions we want to answer. The first one is which accounts are affected. The second one is for the first question, which accounts are affected, we will have to identify at least 2 accounts, okay, minimum of 2 accounts. So in all our examples, we have 2 accounts affected, which is fairly simple. But in your tutorial questions, next week or the week after, you will see multiple accounts. Okay, so you could have 3 accounts, you could have 4 or 5 accounts affected. The second question is what happened to these accounts. You will need to identify for each account. You will need to identify if that is an increase or if that is a decrease. The third and the final question is after you have answering the first 2 questions, please check if your accounting equation remain in balance or not.